This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
This is the first of 4 lectures on discounted cash flow techniques, chapter 10. And in this chapter, there are 4 types of arithmetic that you've got to be competent in, 2 of which you've seen before in earlier exams, and 2 of which are new to the syllabus. The 4 areas, the first is standard net present value calculations. That is purely revision, but you're certain to be asked some sort of net present value in the exam. Secondly, calculations of internal rate of return. Again, you've done that before and is purely revision. The third one, though, is something new at paper P4, something called the modified internal rate of return, which isn't difficult, but certainly stands to be asked. And the fourth one, again new to P4, is multi-period capital rationing. You've heard of capital rationing before, but in previous exams it was single period. In this exam it can be taken slightly further. So those are 4 areas, and in this lecture we'll have a bit of revision. We'll look at the first of the 4, net present values, where, if you remember, in principle it's easy enough. It's a question of setting up the cash flows from a project, or possibly, as you'll see later, for a business as a whole, but setting up the cash flows and then discounting. And the little problems that can occur in setting up the cash flows. There are 3 main problems to make sure you can deal with. Make sure you can deal with inflation. Make sure you can deal with tax. And make sure you can deal with working capital flows. Now, as I say, you have done all of this before. There's nothing new, and the only way really you can revise it and make sure you're competent is by trying questions. What we'll do here is just look at one fairly short question together to remind you of the way we deal with the different things. But then it really is up to you to practice as many questions as you can and get used to all the tiny little tricks that you can put in. So the question we'll look at is on page 46 of the notes, example 1. It's Rome plc. If you have a quick look with me without reading the whole question yet, it says Rome plc is considering buying a new machine in order to produce a new product. There are then various cash flows mentioned, the cost of the machine, production costs, etc. We'll read that when we need. At the halfway down, there's mention of inflation. Materials are going to inflate at 8% and so on. There's a little mention towards the end of working capital. And there's tax, capital allowances, tax 25%, whatever. Our job's to calculate the NPV and advise whether we should accept or not. And so let's see how efficient we can be. Let's go through and deal with all the problems. Get in the habit, first of all, before you start reading in too much detail, sort out how long this project is going to last. How many years are we appraising over? And here it doesn't take long to find. It's the second line. The machine will cost 1.8 million. It's expected to last for 5 years. And so essentially we're looking at 5 years worth of cash flows. Set it up in columns. That's the way the examiner sets out his answer. So let's have column 0 for now. 1 year, 2 year, 3 year, 4 year, 5 year. Always leave a little bit of space, because if you remember, when there's tax involved, fairly often you might need 1 extra year. We'll set up the cash flows for each of the years, look at the net cash flow, and then we'll discount. Again, watch the order we do things. For tax reasons, which if you've forgotten will hopefully become obvious as we go through, always look for the operating cash flows first. And by operating flows, we're talking effectively about the profit and loss, the income statement items, but in cash terms. So normally what we're talking about is our sales revenue and our expenses. So let's deal with them. First of all, what's the sales revenue? If you look at the fourth line, we expect to produce 100,000 units per annum of the new product. It'll be sold for $20 per unit in the first year. So our sales income, our sales revenue, remember we assume cash flows occur at the ends of years, or operating cash flows. So the first year's revenue will be at time 1, it'll be in 1 year's time. And it says we're going to produce 100,000 units. The selling price in the first year is $20. And so the revenue in the first year is going to be, what, 202 million. In the exam, unless he says otherwise, use a bit of sense, work in thousands. So the revenue, the cash revenue in the first year will be 2,000. From now on, everything's in thousands. It's going to be 100,000 units a year. However, there is inflation. It says, about 2/3 of the way down the question, that we expect to be able to increase the selling price of the product by 7% per annum. So although in the first year, specifically it said we're going to sell at $20, in the second year it's going to be 7% higher, and so on. And so, don't show the workings again, but if it's 2,000 in the first year, to add on 7%, multiply by 1.07, and the revenue in the second year is going to be 2,140. And so on, add on 7% a year. Don't waste time showing all your workings. Show your workings for one of them, as I've done there. In case you've misread, it's clear we know what we're doing. But if anything else goes wrong, he will know it is just simply a calculator mistake. So at 7%, if I keep to the nearest thousand, at time 3 it's 2290. At time 4, 2450. And at time 5, 2622. Simply multiply by 1.07 each year. What about the costs? Well, I think it's the fifth line. Production costs per annum, per unit rather, are as follows. First of all, materials. Materials are $8 a unit. We're producing, remember, 100,000 units, so that's 800,000. But do be careful. Here it says those costs, materials $8 a unit, are quoted at current prices. And so it means if we were buying it this year, we'd pay $8. But of course, we haven't bought the machine yet. The first purchases are going to be next year. And therefore, by next year, the price will have gone up. It says below, materials are expected to inflate at 8%. And so, the actual cost, the actual cost in the first year, there are 100,000 units. At current prices, it would be $8. But by next year, when we do make the first purchase, it'll be 8% higher, multiplied by 1.08. Which means the cash payment at time 1, again we're working in thousands, remember, so 100 times 8 times 1.08 is 864. And do see the difference in wording between the materials and the sales price. The revenue, we were told the selling price was $20 per unit in the first year. So it was actually 20. And each year thereafter, it inflated 7%. As far as materials, though, are concerned, it's $8 at current prices. And so in the first year it will be 8% higher. And again, presumably it'll carry on going up at 8% each year, and so multiply by 1.08 each time, and the material cost time 2 is 933. At time 3 is 1008. At time 4, 1088. And at time 5, 1175. Oh dear. Oh, that was right. Go back to after I said 1175. Cut out everything from when I wrote down and said 1175 in the 5th column to what I'm about to say now. Okay, that's materials. Now let's go on with labour. And in exactly the same way. Labour is $7, but it's quoted at current prices. Below, it's inflating at 5%. So in the first year, 100,000 units, $7 a unit, but by next year 5% higher, means the cost at time 1, 100 times 7 times 1.05, will be 735. And then, of course, multiply by 1.05 each year to inflate. So at time 2 gives us 772. Time 3, 810. 851 and 893. So there's labour. And remember, for the moment, we're only looking for operating flows, income statement items. So we've got the revenue. Are there any other costs? Well, we dealt with materials, we dealt with labour. Fixed overheads. Fixed overheads of the company currently amount to $1 million. The management accountant has decided that 20% of these should be absorbed into the new product. Now remember, this is really from management accounting, but we can absorbing means charge, and we can charge individual projects with whatever we like for profit purposes. But all we care about here is, are there any changes to the total cash flows? Here it says fixed overheads are currently $1 million. There's no mention that the total is going to change. We might charge that $1 million differently between projects, but if there's no mention of the total changing, presumably, therefore, there's no extra cash flow, and therefore it's irrelevant for this exercise. If the question had said that fixed overheads increase by 20%, that would have been different. The extra cost would have appeared. But here, no. There's no change in the total. No other costs here. And so the net operating flow, or cash flow each year, check me, but 2,000 minus 864,735. The first year is 401. Second year, 435. Third year, 472. Fourth year, 2450, 1088, 511, and finally the fifth year, 554. Now, so this is a short one. In the exam, there's likely to be more costs involved, but it should be more a question of time pressure and careful reading as opposed to technical difficulty. However, there's the net operating flow each year, the next step is to deal with the tax on the operating flows. Because although you can deal with tax slightly differently and end up with the same answer, by far the most efficient way is to work out what tax would be payable on those operating flows. There are, of course, going to be capital allowances, but to work out the tax benefit from the capital allowances separately and show it separately. So first of all, let's work out what the tax would be if there were no capital allowances. And it says near the bottom of the question, the tax is 25%. It's payable immediately. And so were there no capital allowances, the tax at time 1 would be 401 times 25%. To the nearest thousand is 100. At time 2, 435, 25% is 109. At time 3, 118. At time 4, 128. And finally at time 5, 139. Here the tax is payable immediately, which will probably be the case in the exam. Remember, the only other likely alternative is that tax is payable 1 year later. If we were told tax was 1 year later, then each of those tax flows would move forward a year. It would be time 2 through to time 6 instead of, as it is here, 1 to 5. They're clearly outflows. We'd pay tax on those effectively profits before depreciation, before capital allowances. Next, look for any capital flows. And by capital flows, all I mean is the original cost and any scrap value. And those two almost certainly will be easy to find. First of all, the cost, in the second line of the question, the cost is 1.8 million. One would assume payable immediately. The project lasts 5 years. Its sales value or scrap value at the end of 5 years. With a receipt and inflow of 1 million or 1,000. However, of course, because of the capital expenditure, we'll be entitled to capital allowances, and the capital allowances will result in less tax payable each year. And so, now look at the tax saving that will result from the capital allowances. Now remember, we've worked out the tax on the operating flow as though there were no allowances. Allowances would reduce tax payable. Well, we'll treat any tax saving as effectively a receipt. Now this is the one place you will need almost certainly to have separate workings. So let's do our capital allowance workings. And capital allowances, he'll always give you the rule, and here, again towards the bottom, it's 25% reducing balance. And so, the first computation, well, the original cost was how much? It was 1.8 million. Capital allowance, 25% reducing balance. So sorry, let me set it up slightly differently. The cost was 1.8 million. The first capital allowance computation will be 25% of cost, which is 450, giving a tax written down value of 1350. Now before you carry on and do the later years, it's going to be 25% reducing balance, so it's now just an arithmetic exercise. Make sure you check 3 things. Firstly, do remember that the allowance will be 450, therefore we'll save tax on 450, but the tax saving itself, we'll need to apply the tax rate to it. So the tax rate here is also 25%. So the first allowance will result in a tax saving. 450, 25% is 112.5, let's say 113. Secondly, watch when we make that saving. When are we going to get that saving? Well, occasionally, certainly in earlier exams, there could be a little problem. Here, the chances of any problem are remote. We'll assume we make the saving against the first tax liability. So our first tax liability was at time 1, and therefore we assume we'll make a saving here of 113 at time 1. And of course each subsequent saving will be 1 year later. Finally, and I'll remind you why this is important afterwards, but finally, check how many allowances there are going to be. Here we've got the machine for 5 years, and so there'll be a capital allowance computation for each of the 5 years. But remember, we can't pool assets as would happen perhaps in real life. So although we're going to do a computation for each of 5 years, the first 4 of them, it'll be 25% reducing balance, but the last year, the 5th year here, we'll need to look for a balancing allowance or a balancing charge. Let me remind you, for the first 4, it will be reducing balance. So the second computation, it'll be 25% of 1350, which is 338. Bringing us down to 1012. The tax saving 25% of the allowance is 85. It's at time 2, 1 year later. The third, well again 25% is 253, bringing us down to 759. The tax saving at 25% is 63, I think. And the 4th year, $759 at 25% is $190. And it brings us down to 569. Well, fine. The reducing balance should be no problem once you've started, and it's 25% each year. However, it's every year until the final year, which here, the 5th year, is the last year. And remember, because we can't pool assets in this exam, in the final year, we have a balancing allowance or a balancing charge. We simply deduct the sale proceeds, which are how much? Back to the third line, they're 1,000. And the difference is either a balancing allowance, if you haven't had enough allowances, or a balancing charge if you've had too many. Now here, of course, we've had too many, without giving a tax lecture, we're allowed to write it down from 1,800 cost to a value of 1,000, so allowances of 800 in total. We've had far more than 800 because we've brought it down to 569. So the difference here, 1,000 minus 569, the difference of 431 is a balancing charge. There'll be a balancing charge of 431, and therefore we'll have to pay tax, extra tax at 25%, which is 108 at time 5. So for the first 4 years we're saving tax, these figures here. Here for the 5th year, because we've had too many allowances, we'd actually have to repay tax. Having done our workings, now we can go back to our cash flow schedule. The allowances, 113.85. Where are we? 113.85. I think it was 68. I'll check in a minute. Or 63. I'll change 63 and 48. And remember, they're tax savings, so they're like cash inflows. Finally, though, in the 5th year, with the extra tax payable, the balancing charge of 108. Now, before we carry on and finish off, just one small point, which again I think you should remember anyway. In the 1st year, in fact, the allowances, the capital allowance in the 1st year, which was what, 450, was greater than what effectively was the taxable profit of 401. So it would actually mean that this project made a tax loss in the 1st year. However, remember, there is absolutely no question in the exam of dealing with losses. We assume that we've got plenty of other profits elsewhere that we're already paying tax. And therefore, if this project happens to lose money, it just means overall there'll be less profit, and therefore overall we'll pay less tax, we'll save tax. And that's what's happened. There's a net tax saving of 13. So there's nothing to worry about. It's the normal rules. It's irrelevant whether individually it would appear to have made a loss or not. However, not quite there. Finally, look for any cash flows that have no tax effect, and the most likely one, as here, is working capital. Remember, working capital is extra cash needed to finance things like extra inventory levels. Here, we need an extra 200,000 at the start of the project. Well, two things. Firstly, we need extra cash, so with an extra payment at time 0 of 200. Secondly, though, there is no tax effect, which is why we leave this till the end. Simply increasing or decreasing inventory levels doesn't affect our tax liability. But finally, unless obviously you're told differently, you always assume that any working capital will be released at the end of the project. So throughout the project here, there's 200 tied up in working capital, but at time 5, at the end of the project, we assume we get that 200 back. There are the cash flows, so let's look at the net cash flow. You better check my arithmetic here, but I think a net outflow of 2,000 at time 0. At time 1, a net 414. Time 2, 411. Time 3, 417. Time 4, 431. And finally, at time 5, a net cash inflow of 1507. Incidentally, although obviously we've yet to discount, this was deliberately a fairly short one. I've already said in the exam there's likely to be more cash flows involved. And so there'll be more time pressure, there'll be more places where you could make silly arithmetic mistakes, there'd be clearly more reading to do, but there's no reason why it should be technically any harder. But do watch how you set it out, because the nice thing about these is that provided you set it out nicely, it's more or less like I've done here, each line would be marked individually. So clearly on any one of those, maybe I've made a silly mistake, but just getting, for instance, labour wrong would only lose perhaps a mark here. And still get full marks for everything else. Things like the tax, as long as it's clear what you've done, even if you'd made a mistake and got your operating flows wrong, for calculating the tax at 25% of your figures, you'd still get the mark for the tax flows, even though obviously if the operating flows were wrong, the tax as well is wrong. So take the trouble to set it out nicely. Don't show pages of workings, but show enough workings to make it clear you know what you're doing. Finally, the discounting, and I'm afraid the discounting itself should be automatic. Make sure you don't waste any time at all here. In this one, the cost of capital is given us. In other questions, of course, you may have to work it out, and there'll be more marks for calculating it. But here it's given at 10%. And so once we've got the cost of capital, simply write down the discount factors from the tables: 0.909, 826, 751, 683, 621, and therefore the present values are there. The net present value, add them up, and I get a net present value of plus 258. And of course, don't forget the conclusion. May only be half a mark, but to lose that would be dreadful. The fact that it's positive, the net present value, we would accept the project. Had it been negative, we'd reject. Subject, of course, if you got the chance in the exam, subject, of course, to the accuracy of all our cash flows and the timing of them. All of those figures, of course, in real life would be estimates, particularly the rates of inflation, particularly the final sales value. And if any of those estimates are wrong, clearly, so too could our decision be wrong. And of course also the cost of capital itself. We've assumed it's constant at 10%, but if it's any other rate, clearly, again, we could have the wrong decision. Anyway, as I said at the beginning, that should have been purely revision. Make sure you are happy with it. It's up to you to practice as many as you can. If there's anything you're not sure about, go back through that lecture again, slowly, and check on it. Make sure you do agree that answer, though, because in the next two sessions, when we look at internal rate of return and modified internal rate of return, we are going to use the same example, and we'll need the figures that we've calculated here.